Okay, welcome back. There's 20 minutes to go for the pre-open session. Let's get in Pankaj Tibrewal, who's with us now, founder and CIO at IKIGAI Asset Managers. Pankaj, good to have you with us here. Good morning. Thanks very much. We all remember the time you said time to be a risk manager rather than a fund manager, and the risk is playing out now. And I was looking at the fall from the highs. Nifty, I think, is down some 16. Small cap index is down about 18% or so. This is from the all-time highs. I mean, just your thoughts, Pankaj. I mean, we all knew broadly that there were excesses building up in the system, and maybe valuations were getting too out of hand. So, it was overdone across at many levels. How much of normalization has happened now, in your opinion, Pankaj?
Good morning, Prashant. As you would recall, we have been extremely cautious on the markets for the last many quarters. And the basic premise was that economy was going through a mid-cycle soft patch as far as growth was concerned. However, when we look at the data now, I think certain things are changing for good, which market is not recognizing, which probably with the lag market will start to take into consideration. And don't forget that market is a Triveni Sangam of three things: fundamentals, flows, and sentiment. And we'll touch upon each of them in greater detail. Let's look at the fundamental side. In our opinion, economy last year for a few quarters went through a slightly softer patch as far as growth was concerned. I think that has started to change. Look at the few data points. The first one was a concern on government capex spend. Till November, we were down by 12% year on year. And December saw a very strong, comeback. And that number now is 1% higher on a year-on-year basis. And if budget revised estimates are to be believed in, January to March quarter, you have to compound at about 20% growth year-on-year for the 3 months to achieve that number, which is a very strong number. So I think government capex has started to come back. And even in this budget, the number of about 14.5, 15 lakh crore, including the state grant, is not a bad number to go with. So our sense is that government capex is coming back. The second is on the RBI side, which most of the market participants are ignoring. I think we have seen the first rate cut after 5 years. Liquidity, as I've been saying, has been extremely tight when we speak to dealer distributors across corporates. I think that has started to ease, and you have seen strong open market operations by RBI and liquidity bazooka over the last 15 days, 20 days, and followed by a rate cut. So monetary policy action has started after a long time, and even the regulator is acknowledging that there was a mid-cycle slowdown. I think we have to take that into consideration, which is a very big positive. The third important point is that the budget was a very balanced budget, and we have talked about it in greater details few weeks back. And my sense is that in the second half of FY26, the bonanza which have been given to the middle class consumers should start showing results. Fourth, when we look at the earnings for this quarter, till a couple of days back, 386 companies out of the NSE top 500 companies have reported. And earnings season has not been as bad as feared at the start. Let's look at the numbers. The top 500, 386 companies have reported 15% earnings growth. Even adjusting for few one-offs, which were in cases like Bharti and others, still it's a high single-digit growth. And if we break down into BFSI and non-BFSI, 84 companies are from BFSI segment, which have reported 22% earnings growth. And the non-BFSI rest 302 companies have reported about 12% earnings growth. And don't forget that commodities have been under pressure. If we adjust for commodities, that's a 20% earnings growth, which is not bad at all from an overall what we have seen for the last few quarters. So earnings is coming back. And finally, stocks are slave of earnings. And from another perspective, if you look at the high frequency data, January, when we look at the toll collection, the credit card spend, some of the other high frequency like electricity generation, they all have started to recover from the softer patch which we saw for the last few months. So I believe that economy is making a comeback led by both monetary and to a certain extent the fiscal part, which will play its own role going into FY26. And earnings should be better in the fourth quarter as well. So our sense is that the valuations which were a concern have probably been taken out now. The excesses have started to get removed. It will not be an easy market, as I've been saying this year. The macro trade is behind us. Post-COVID, it was all about macro trade. Everything was sailing in the same boat. I think now onwards, it will be a micro market. It will be a stock pickers market.
Got it. Pankaj, sorry, just to clarify, 386 companies which have reported so far have seen 15% earnings growth or revenue growth.
Earnings growth, PAT growth.
PAT growth. Okay, we should just make that correction. 15% PAT growth is what you're saying. And just have you looked at valuations as well now? What were they at peak, mid caps and small caps, where they are now?
So let's, for a time being, park out the mid and small cap argument for the time being, and let's look at the overall valuation. This year, our sense is Nifty EPS will be about 1,040 to 1,050. Even if you pencil in about 10 to 12% earnings growth, we are talking about 1170, 1180 for the next year for Nifty. And even a 10% earnings growth will land up to about 1280, 1300 rupees somewhere around in FY27. From that perspective, 18 times on FY27 earnings is not very expensive as far the frontline indices are concerned. Now look at the mid cap and the small cap, where a lot of arguments have been going on and a lot of debate have been going on. You'll be surprised to know that out of the mid cap 150 index, 120 companies had reported their results a couple of days back. And the numbers were 29% earnings growth. Even if we adjust for a few of the one-offs like HPCL, IRB, Infra and all, still you're talking about 14-15% earnings growth in mid cap, which is not bad at all. Small cap segment has been a little softer in terms of 10 to 11% earnings growth, which in my view is also not bad, considering that you had a couple of quarters of very softer economic growth in the country. So I believe that broadly the earnings season, though FY26, numbers have started to get adjusted in terms, they were higher at 15-16% earnings growth. I think they will finally adjust at about 10 to 12% earnings growth. But I think a lot of excesses have started to take off and valuations have not been that bad. Also, Prashant, don't forget that when we are meeting corporates in different conferences now, when we are listening to their conference calls, fourth quarter has started on a decent note. And our ground feedback suggests that cement demand has been very, very strong, led by the government push as well as housing doing quite well. Cable demand has been quite strong. Most of the other segments which are related to the core part of economy has started to make a comeback. So I think markets have probably reacted what we saw in the June-September quarter now. Probably what is happening, probably markets will take a cognizance maybe in a couple of months from here now. But what I would suggest is that market in many pockets have started to look attractive. And I will definitely, what we are doing is advising our clients that over the next couple of months, start accumulating into the market where we have been cautious and we are turning a little constructive on the market, though we are not going whole hog, but we are trying to see pockets of opportunity out there. And that has started to emerge after a long time.
Got it. Pankaj, great to have you on the show. And what you're suggesting is that there seems to be pickup on the ground, but the market hasn't yet started valuing it or giving it enough credit. Usually the market's supposed to be running ahead of the event, but in this case, it might be a little lagging. So just narrow this down further. What you're saying is you're not averse to mid-caps. You're expecting CapEx to be fairly okay as well. So now, which pockets could be the new leaders? Will it be the same themes? EMS, CapEx, your engineering companies, industrial stocks, will it be the same? And if yes, are you comfortable with the valuations now? Or could we be looking at an absolutely new set of sectors and themes that will dominate the market once we get out of this fall?
So, I think now what will happen is there will be a reset in the market. Many stocks where only narratives were working without balance sheet cash flows will take a backseat. And I think markets will get narrower and narrower and very few handful of stocks will probably perform. So it will be painful from that perspective and it will be a stock pickers market. There are two important points to note that there is a style change which is happening after a long time. After 4 years, post-elections, we have started to see that three styles have started to perform better. One is low volatility, one is growth, and one is quality. And growth and quality, after the underperformance of value, almost they have hit a 15-year low, they have started to make a comeback. So I think in this fall, everything is falling. But after, once the market starts to settle down, there will be few stocks and sectors which will start to do well. Which are those? In our view, first, I think we should take a view on chemicals as a sector. I think in this fall also, this sector has stood out quite tall. And that's because the earnings have been very strong across the sector. After 8 quarters of decline on an aggregate profitability pool, this sector has started to show signs of life, and you have started to see earnings growth coming back. And the outlook across most of the large companies in this sector has been quite promising. The second is the banking sector. I think with RBI coming and easing liquidity, I think you will see banking sector, the entire BFSI space started to perform again. And in this fall, you saw that Bank Nifty has actually done better than most of the other indices as we speak. The third part is the cement side. I think cement demand has been quite good. And our sense is that pricing will see an uptick as you gradually move forward, which will straight flow to the bottom line. And I think incremental change for the next 4 quarters on a profitability growth will be quite positive. Fourth, I think consumer discretionary. And I think this is more of a second half FY26 play, because more money in the hands of consumer post the budget. I think you will see many consumer sectors started to make a comeback. So I think if you broadly, and pharma obviously is the other part where we believe that valuations are not prohibitive, business models are strong, cash flows are strong. Surabhi, I would just like to say that it's very easy to get flow down with the negatives. But let's look at from a flow perspective, one important data. CY21 till CY25 year to date, domestics have poured in $140 billion in terms of flow in the market. And FIs have been cumulatively negative in this entire 4.5, 5 years, which means that at some point, FIs, whenever they make a comeback, you won't get markets at such levels. So I think from here on till the next few months, we would advise that look to accumulate stocks from a 2 to 3 year perspective. Don't get swayed by all around negativity, which we have been talking about. Incremental change in economy is turning out to be positive. Government has started to act, RBI has started to act, and you are starting to see private capex and housing cycle quite intact as we speak. So we would look out for opportunities across sectors and make sure that we have few names in our portfolios, which from a 2-3 year perspective can compound their earnings between 15 to 20%.
All right, Pankaj, always a pleasure having you on the show. Thanks a lot for putting out those data points, turning more constructive rather than being cautious. The past quarter's earnings were not as bad as everyone's talking about. And some of these high-frequency data points now are indicating that there's a recovery in sight. So, good time to form a portfolio.
Nigel, so many numbers, right?
Yeah.
Pankaj is always with a...
386 out of 500 companies delivering 15% EPS growth. And
which is not bad.
Which is good.
Not bad. Absolutely. Good perspective, especially at a time like this, Pankaj. Thank you very much for joining us here on CNBC-TV18. And we look forward to our next one. Thank you. We'll take a quick